The economy functions through three distinct sectors. While the public sector provides services through taxes, and the third sector supports social causes, the private sector is driven by the pursuit of profit. Take a young Scottish entrepreneur starting a custom PC building business from a bedroom. He is operating as a sole trader, the simplest business form, where a single individual owns and runs the entire operation. This model requires minimal legal setup, making it cheap and fast to start. Because the owner has total control, he makes every decision and retains every penny of the profit. However, a sole trader's growth is strictly limited by their own time and personal savings. To expand beyond a bedroom operation, the owner needs more than a single person's resources. To meet rising demand, the founder brings in a partner. They sign a deed of partnership, legally evolving the business into a structure shared by 2 to 20 people. Teaming up allows them to pool their savings from more capital and share the heavy workload. It also brings in specialized skills, like one partner handling technical builds while the other manages sales. But scaling introduces new dangers. If a workshop fire destroys their uninsured inventory, the partnership can fall into massive debt, owing more to suppliers than the business actually owns. This highlights the risk of unlimited liability. Legally, the owners and the business are the same. If the company fails, the law dissolves the barrier between business debt and personal wealth, meaning the founders can lose their cars, homes, and savings to pay creditors. As an operation grows, the threat of personal financial ruin eventually outweighs the benefits of maintaining total control. Incorporation solves this risk. By registering with Companies House, the founders create a private limited company, or LTD. This establishes the business as a separate legal entity, distinct from the people who own it. Under the Memorandum of Association, investors gain limited liability. They only risk the money they use to buy shares, and their personal assets remain protected. In exchange for their investment, they receive a share of the profits, known as dividends. If the company needs to build a large-scale factory, it may require at least £50,000 in share capital. At this stage, the business must evolve into a public limited company, or PLC. This photo of a stock exchange floor shows the scale of public trading. A PLC can raise massive sums of capital by selling shares to the general public and large financial institutions like pension funds. Massive growth brings a loss of independence. Ownership is now separate from control, as the company is run by a board of directors. Furthermore, because shares are sold publicly, the company faces the constant risk of a hostile takeover. Incorporating protects an entrepreneur's personal wealth, but it forces them to trade away absolute authority over the company's future. When a large PLC exhausts its domestic market, it may establish production facilities in other countries, becoming a multinational corporation. Multinationals pursue global scale to avoid trade barriers, secure foreign government grants, and lower their costs by buying materials in massive bulk. This shift often relies on repetitive assembly line work. By moving to countries with relaxed labor laws, multinationals can exploit low-wage environments to maximize the profits sent back to their headquarters. Negligence in these environments can be fatal. The Bhopal gas disaster memorial stands as evidence of what happens when a multinational cuts corners on safety and social responsibility, leading to thousands of deaths and long-term environmental damage. Multinationals achieve unmatched scale, but their economic power can easily lead to the exploitation of the host countries that house their factories. There is another path to growth: franchising. Instead of inventing a brand, an entrepreneur pays to copy an existing, successful blueprint. This involves two parties: the franchisor, who owns the brand and systems, and the franchisee, who pays fees and royalties to use them in a specific location. The franchisee benefits from a recognizable brand and professional training from day one, which significantly reduces the high risk of business failure. The cost is a total loss of creative freedom. Franchisees must follow the franchisor's rigid rules and hand over a percentage of every sale as royalty payments. Franchising represents a calculated trade. You give up independence and a portion of your profit for the security of a proven business model. Success in the private sector requires matching the legal structure of a business to its current size and goals. Every entrepreneur balances the same three variables: their personal financial liability, their degree of decision-making control, and their access to capital. This comparison matrix is the key to the SQA higher exam. To earn marks, you must directly compare these structures, explaining exactly how the unlimited liability of a partnership differs from the corporate shield of a PLC. Mastering these specific trade-offs provides a clear path to an A grade and a functional understanding of how businesses legally organize for growth.